Welcome to this deep dive. Our mission today, well, it's to cut through the noise. We want to give you, the Gen Z investor, a clearer roadmap towards financial independence.
Yeah, exactly. We're drawing on some solid sources here, looking at those foundational principles, but also how tech is really changing the game for your generation. This isn't just stuffing cash under a mattress, right? It's about making your capital work for you. Grow it.
Okay, so first things first, let's unpack that key difference. Saving versus investing. Saving, that's more for your immediate stuff, short-term goals. Think an emergency fund, maybe.
Or like a down payment you need in the next year or two. The key is security and access. You need that money safe and ready.
Right. But investing, that's different.
Totally different. For those bigger, longer-term goals, investing isn't just nice to have. It's pretty much essential. Why? Simple inflation. Your savings account probably isn't keeping up.
Explain that a bit more. Inflation erosion.
Well, think about it. Prices creep up over time, right? That $10 thing today might cost you $11, $12 in a few years. Savings just sitting there lose buying power. Investing, historically at least, gives you a shot at actually beating inflation, growing your wealth.
Okay, that makes sense. Now, this next bit gets really interesting. Risk and reward. We hear it all the time. But how do you actually figure out your comfort level, especially when things get shaky?
That's the million-dollar question, isn't it? Your real risk tolerance.
Mm-hmm.
It doesn't show up on a questionnaire. It shows up when the market takes a nosedive.
So the difference between what you say you'll do and what you actually do.
Exactly. Your stated tolerance versus your revealed tolerance. Lots of beginners say they're fine with risk, then panic sell at the first sign of trouble. That emotional reaction, that can seriously derail your long-term plan. You got to try and keep a cool head.
So if inflation is the villain, slowly chipping away, what's the superhero? What builds wealth?
That leads us right to what some call the eighth wonder of the world. Compounding. It's basically interest earning interest, or returns generating more returns. It snowballs.
And this is where Gen Z has a massive edge, right? Time.
A huge edge. The average Gen Z investor starts around age 19. Think about that. Baby boomers started, on average, 16 years later. That head start is incredibly powerful because of compounding.
Just how powerful? Give us an example.
Okay, one source had this hypothetical. Start at 25, put in $5,000 a year, get an average 7% return. By age 65, you could be looking at over $1 million.
Wow. And if you wait?
Start just 10 years later at 35. Same scenario otherwise. You end up with less than $500,000. Time is literally money here.
But there's a flip side to compounding, isn't there? Something that works against you.
Oh, yeah. The dark reflection, fees, they compound too, but in the wrong direction.
Yeah.
A seemingly tiny 1% annual fee. On a $100,000 investment over 30 years, that could cost you over $150,000 in lost growth compared to no fees.
Ouch. So keeping fees low is critical.
Absolutely critical. Non-negotiable, really, for long-term success.
All right, so we've got the mindset down. Beat inflation, manage risk, harness compounding / fees. Now, the toolkit. What do you actually invest in? Picking individual stocks seems daunting.
It is. For most people, it's like finding that needle in a haystack. Blindfolded, like you said. That's why pooled investments are so useful. Things like exchange-traded funds, ETFs.
Okay, ETFs. Break those down.
Sure. Think of them as baskets of investments. They give you instant diversification. You own tiny bits of many companies. Costs are often very low, especially for index ETFs that just track a market, like the S&P 500. Plus, you can buy and sell them easily throughout the trading day, just like stocks. They're kind of the default choice for many investors today.
Makes sense. A move away from expensive managers who often don't even beat the market anyway.
Exactly. But there's another layer for Gen Z, this whole digital world. Social media. Finfluencers.
Ah, yes, the finfluencer phenomenon. It's a weird paradox, right? Like, sources say Gen Z knows social media is the least trustworthy place for financial advice.
Yet they use it because it's free, it's accessible, it's, engaging. TikTok, Instagram.
But the risks.
Huge risks. Unqualified advice. People pushing products for their own gain, zero personalization, outright scams sometimes. You have to be skeptical. Verify everything. Ask yourself, is this person qualified? Are they objective? What's their incentive?
Treat it like gossip, basically. Don't bet your future on it.
Couldn't have said it better. Now, this links to another trend we see, this barbell approach in some Gen Z portfolios.
Barbell? What's that?
It means extremes. On one end, lots of cash, super safe, maybe too safe, losing to inflation. On the other end, extreme speculation. Crypto, meme stocks, you name it, all high-risk bets.
So they're missing the middle.
Yeah, often neglecting that crucial middle ground. Diversified, low-cost, boring but effective stock and bond index funds. The stuff that builds wealth steadily over time.
Okay, so how do you structure things better? Is there a framework?
There is. A really robust one is the core satellite approach. Think of it like a solar system for your money.
Okay, I like that. The core, that's the sun.
Pretty much. It's the bedrock, the stable center. Makes up the bulk of your portfolio, maybe 70%, 80%, even 90%. This is your long-term, set it and mostly forget it money. Think low-cost target date funds.
Those adjust automatically as you get older, right?
Yep, they dial down risk over time. Or just broad index funds, U.S. stocks, international stocks, bonds. Keep it simple, diversified, low cost.
Got it. A core, stable foundation. Then the satellites.
Those are your smaller bets orbiting the core, maybe 10% to 30% of your total. This is where you can take more specific risks, experiment a little. Individual stocks you believe in, maybe themed funds like ESG.
Environmental, social governance stuff.
Right. Or even a small allocation to crypto if you understand the risks and can afford to lose it. The point is, if a satellite blows up, it doesn't destroy your entire financial future because the core is secure.
That makes a lot of sense. Manage risk, but still have room for potentially higher growth or just more interesting stuff. Investment apps. They make it easy, maybe too easy.
That's the danger. They're convenient, absolutely. But many are designed like games. Push notifications, flashing graphics. They can trigger emotional decisions, encourage frequent trading, which is usually bad for returns.
So use the tech, but resist the manipulation.
Precisely. Turn off those notifications, set up automatic investments, pay yourself first, automatically. Stick to the plan you made when you were calm and rational. Don't trade emotionally.
Okay, wrapping this up then, what's the big takeaway?
It really comes back to that first point about Gen Z's advantage. Your single greatest asset, it's time. Decades of it, potentially.
So the final thought we want to leave you with is this. You're digitally native, you have access to tools and information like never before, and you have time on your side. How will you combine that digital savvy with these time-tested principles, discipline, diversification, cost control to build a truly resilient financial future? How do you balance that new frontier excitement with long-term wisdom?